So hello everyone. So hello everyone. Good morning. Congratulations on making to the next round. All of you did a very good job. But it's a finathon, so the next round starts now. I hope all of you have gone through the brief that we had shared. I'll take any quick questions before we get into. So like we did for round one, we'll go into a template which kind of gives a brief overview of how you can approach the entire problem, and we'll go through that and take questions later on as well. But if there are any initial questions on the brief that we had shared, happy to take that in the beginning, and then we can start with the template. Okay. I don't think there are any other questions, so we'll dive right in. So, so essentially the mandate was to make a financial plan, and what we've done is we made so so essentially the overall mandate was to build a financial plan. And what we've done is we've laid out some sheets that can give you a quick, rough idea about how to go about it. So the core idea is to build a set of financial statements that project the business. The overall perspective, of course, is to build a business case. Now, when you build a business case, essentially the idea is that you're pitching it for investment. So you're essentially your core audience is an investor who's looking to decide whether or not to invest in the business. So you can look at a period of 5 years or 10 years or 7 years, whatever it is that you feel is relevant to project the business and then show key output variables for the business. And the typical way to do that is to essentially show a P&L statement, which is a profit and loss statement. And you can quickly look it up and give a good simplified P&L statement for the business that you are looking to project for. And below the P&L, you should also put in a cash flow, because ultimately a business is valued on the basis of the amount of cash it throws up. And that's what you need to take into account. So what we'll do is we'll go through the heads that are there in these financial statements, and we'll talk about how each of those heads can then get populated. So that will essentially build the entire thing from beginning to end. So if you look at P&L, there are several heads. So there would be, this is we built it for the D2C brand. So there would be a certain amount of revenue coming in, or the revenue essentially is sales. So there would be a certain amount of revenue, and there would be a revenue growth percentage coming in. I've not done any calculations here because all of you guys have done these calculations for your for round one, and all of you are pretty familiar with it. And some of it has been very impressive as well. So you have to essentially model out how your revenue will move across the years. Basis the revenue, you should also be able to understand how your margin will move. Now, your margin is a function of what gets left over after you account for COGS. COGS is cost of goods sold. So once you remove the cost, whatever is left is your margin. Then you would have a bunch of other costs that would come in. So things like supply chain costs, the logistics costs, the marketing costs, the tech team costs. There would be media costs. There would be different kinds of, there would be market activation costs. There could be any kind of cost that would come under that business. And that is what you need to flesh out. So once you take care of all of those costs, what you would get is essentially a total OPEX of the business, which is OPEX is nothing but operational expenses. So that's an abbreviation. And once you remove the OPEX, what you get is your operating profit or your EBITDA. EBITDA is essentially nothing but an acronym for earnings before interest, tax, depreciation, and amortization. So it's just a fancy way of saying this is your operating profit. Once you get your operating profit, you can remove your depreciation, you can remove your interest, and then you can remove your taxes for you to finally get your PAT or profit after tax. So that's the way your P&L needs to be structured. Okay. I'll stop here for a second in case there are any questions, and then we'll move forward. Yeah, Pulkit, go on, please.
Yeah, in the document, there was this specific line mentioned that the idea, since the idea is already given, you won't focus that much on the idea, but how we financially project it, correct?
Yes.
So even if we take a basic idea that is already given in the list and we add a lot of details in our financial model, that's better, right? Instead of
Yes,
making
yes.
the business idea complicated.
Yes, yes, yes. Instead of
So
focusing on build, see that's why we gave the business idea so that you don't spend too much time on building out a business idea. The idea is to now take that core proposition and flesh it out as well as you can. and build a very
Okay, so
comprehensive
we
financial
won't be
model.
marked based on the idea, but we will be marked based on how we project that idea.
Yes, yes. Now, if you
So,
feel that you'll be able to project another idea better, well and good. That is what I mentioned on the group yesterday. But
yeah.
that's not something that we are going to evaluate you on.
Okay, so no matter the business idea, you will only see this sheet and see how better you can understand our business
How
model
well
from
you
that.
are able to model it, and how well have you considered the overall business and considered all pros, cons, all factors. Okay.
And on 6th and 7th, what will be the procedure? Like you will ask us questions about the business or about the sheet.
About the sheet, how you've taken your assumptions. See, your
Okay,
assumptions
okay.
need to make some
It's the
amount
same
of
thing
business
as round
sense.
one, but the topics is changed.
Yes, yes, it's the same thing as
Okay.
round one, but the topic is. So if you think about it, finance, what round one was about was essentially about personal finance. It's about your own personal finances, your own personal wealth, your own personal net worth. Here we are talking about the same thing, but from a business's perspective.
Yeah, I got it. Thanks.
Got it?
Yeah.
Okay. I see a bunch of other hands. Let me just see. I can see Arnav and then Kushan. Arnav, go on, please.
So you spoke about projections. So should the projections be like just for the next year, or should it be like over like a 2, 3 years period time or
They
something?
should they should be for about 5 years, but you can choose to project for a little more as well. But typically, about a 4 to 5 year projection is needed for you to value any business reasonably well.
So should we show the projections year on year, or should we show it like just separately?
No, year on year, year on year. So if you see
Okay.
this model here, it's bit like that. So there is a year zero, which you can assume for things to set up the business, and then year one, year two, year three, year four. Clear?
Yeah, thank you.
Okay, Kushan.
Are we expected to make a dynamic model like we had to make something for round one, or does it have to be with like extreme niche detail that's specifically tailored to our business?
What do you mean by dynamic model?
As in like mainly revolving around formulas where any business could potentially use it by entering the base values and then a calculation gets passed on, or do we go extremely niche, calculate basically all the personal costs of this specific business?
You should calculate all the personal costs or all the costs of this particular business, and you can make it as specific as you want. But having
Okay.
said that, everything should be formula linked so that when you
Okay.
change the
Okay.
assumptions pertinent to this business, then your model outputs can change.
Okay. Perfect. Thank you.
Okay. See, any model is essentially a tool. It helps you understand a few things. It helps you understand the business better. It helps you understand what is important to the business and what is not so important. So, and you should be able to vary different inputs into the model to see how your output parameters change. That is the core function of a model. For that to happen, you need to make sure that you can rework and see different scenarios in the model. And for you to be able to do that easily, the model should be very well linked across. And you should have very clearly defined input parameters.
Got it. Thank you.
Any other questions? I can see one more hand. No, Kushan, we already discussed your point. Okay. Okay. So we discussed the P&L. Now, typically what would happen is while revenue in the P&L statement would be one line, but there would be a bunch of calculations that would go into calculating revenue. You would look at potential, you would look at how many cities you're going into, how much of an investment you have in infrastructure, how many warehouses are there, and so on and so forth. Now, all those calculations, it is best if you keep those calculations in a separate sheet. So, for example, if you were looking at revenue, I've just put some line items here which can give you a sense. So, you could look at the number of website visitors on your website or on your app, and of those visitors, the number of people who shop, then the orders per person, the items per order, and the ASP per item or the average selling price per item. So this is just a sample template for you to calculate your revenue. Now, if you multiply the number of people by the orders per person, by the items per order, and then the ASP per item, you will get your total revenue that particular year. Then you multiply that by the percentage margin, and then you can get your margin, and then your calculations can flow from there. So now there will be several assumptions which will drive your revenue. Ideally, you should keep that in a separate sheet. And that's what, and this sheet should then feed into your P&L statement sheet. So for example, if you finally have a line item here which says revenue calculation, and this should be 1, 2, 3, 4 or whatever, right? And this is year, let's say this is year one. Then in year one, your revenue here should link back to this, right? So like this, you should ideally build out all your revenue projections. You should build out all your cost projections. Cost projections, you can approach it. Yeah, Pulkit, go on, please.
Sir, is your screen freezed because I can't see what you're typing?
Yeah, sir, same.
Oh, okay. 1 second, hold on. Let me reshare my screen. Visible now?
Yes, sir.
Visible? Okay.
Yes, yes,
So
visible.
can you see the changes now? Can you see me typing?
Yeah.
Okay,
Yes, sir.
perfect. So what I was trying to say is that, let's say revenue, you did a bunch of calculations and you arrive at a certain number, which is in this cell, which is C18, right? So then your statements should essentially refer to this cell and then, project it like that. Okay. Just a way of keeping your calculations clean. Got it? So you should have ideally a sheet which captures all your assumptions about revenue. You should have a sheet which captures all your cost projections, how your costs are getting built out. Your cost could be variable cost and central cost. So variable cost and fixed cost, that's a good way to think about how the cost for a business happen. Then within variable cost, you would have logistics cost, packaging cost, some amount of marketing cost. Your central costs are essentially those costs which do not increase so much as your business increases. So there's a lot of advantage you get from these costs as your business grows in scale. And this could be things like your central manpower, your tech infrastructure, your tech team, and so on and so forth. And all of this you could then project and then see how they are moving across the years. And when your business breaks even, how much money does your business make? What kind of growth happens in revenue and PAT and so on and so forth. Is that clear? Okay.
Sir,
So now beyond this, what also needs to happen is, so we discussed till the point of PAT. But as I mentioned, a business is usually valued on the basis of cash flow, which is the amount of money that the business generates. And this, if you don't know about it already, you can do a quick read up, but it's not very complex. So essentially, the idea is that there's a certain amount of cash flow that comes from your business operations. There is a certain amount of cash flow that goes into working capital, which is if you want to give credit in the business or if you receive some amount of credit from other people, that's essentially cash that the business is holding. So changes in that change your cash flow. And then finally, if you decide to put in some amount of capex in other words, if you put in some kind of infra, or if you do some kind of tech R&D, or if you invest in something which will last your business for several years, then that's something called capex. And that is again money that will go away from your business. When you combine all of that, you get a final cash flow, which is there year on year. And then you can run an NPV or an IRR formula on that cash flow to finally get a valuation for your business. Okay. Now here you could, every spreadsheet has a direct formula, but ideally it would be good if we could have if you could check that formula also with a manually created formula, which you've done yourself so that you can understand the formula as well about how it works. Okay. So that will close out what we spoke about. So a P&L leading to a cash flow, which would give you some sense of how to value the business and what kind of valuation you're asking for. And then it's not required, but you could essentially go ahead and then build a balance sheet as well, But I mean, it's okay. This time is quite short. If you're not able to do that, that's completely fine. Anushka, tell me, please.
So what is NPV and IRR?
Okay. So IRR, so don't worry about NPV for now, just focus on IRR. IRR is internal rate of return. Okay. Essentially, it's a sense of how much percentage money the business is going to give you. So let's say if the business ends up giving you 100 rupees for 5 years. So let's say if the business gives you 100, 100, 100, 100, 100. Okay. Your IRR is this formula.
I don't put the percentage sign.
Huh? Sorry, one second. I think there's a mistake. What's happening here?
I
Hold on.
don't think you need to put the percentage
Oh,
sign.
yeah, correct.
You should also put plus or minus so the rate can increase or decrease, right?
No, that's not needed.
On top, if you look at the toolbar, there's going to be a percentage
Oh,
sign
yeah.
that
No, hold on. There has to
So
be
you're missing a bracket there.
Okay. Because there has to be an initial outflow that happens for you to get a return on your investment. So then you get this investment. Okay.
I didn't understand. Why did you put 250
So
in the
250. So essentially what's happening here, Anushka, is that whenever you do a business, you'll have to put some money into the business. The 250 represents the money you're putting into the business. So the error that I was doing over here is I was just looking at positive flows coming in without any money going out, which is not possible. So the formula expects you to put in some money, which is a negative in the series, and then some positive cash flows coming after that.
Okay, so understood.
Got it? Okay, we'll pause here. Any other questions?
Sir,
Yeah.
will this sheet be shared with us?
Yeah, we'll share the sheet.
Okay.
See, we're going to follow a very similar thing that we did for round one. So we'll do the briefing, we'll put the recording on YouTube, we'll give you guys the link, and we'll also share the sheet. But it's just a template. I mean, it will be good to have that template, but it's just a template. That's all. Okay. Any other questions? Okay, couple of things I want to clarify. So, Anushka, other people who are not very familiar with IRR and things like that, you can just do a quick read up. You don't need to read anything beyond what I have put over here. It's pretty easy to get it at a basic level. And you can put that in. Having said that, focus a lot on how you're fleshing out the business and how you're modeling it. That's where the core of it really is. Okay.
Okay,
And
sir.
then, yeah, sorry.
No, so I was just saying that I understand what you're saying.
Okay.
So you said not to bother about NPV. Is that something that doesn't come in this model or
It
it's
does. So NPV is another way of evaluating any business. So NPV means net present value. Okay. Quick explanation. So essentially, see the entire model, any business, any personal finance thing is built on the concept of time value of money or compounding, which is what you all did when you built your personal finance plan, because almost all of you had an investment that you were thinking of doing. What does the investment do? It makes sure that your money compounds or grows year on year. So when you value a business, if you get 100 rupees now versus you get 100 rupees 10 years later, The more valuable cash flow is when you get it right now. Correct. So what you get 10 years later is something you need to discount by a certain amount. What is that certain amount? Is the percentage return that you expect. So that's what, now there are two ways of looking at the cash flow. One way is IRR, which essentially says that if this is the kind of return investment you're putting in, this is the kind of cash flow you're getting, then this corresponds to this kind of a percentage return on the money that you're putting in. Okay. That's your IRR way of looking at it. The NPV way of looking at it is to say that if these are the flows you've received and this is the percentage return I expect, then this is the value of the business as of today. This is value of all the cash flows of the business as of today. Assuming the business will not have anything in future, this is what it means for the business value today. Okay. So, for example, if you assume that a business will throw only two cash flows of 100 rupees in year one and 100 rupees in year two, then the value of the business right now will be the first 100, and let's say your percentage return that you expect is 10%. Then your value of the business is 100 rupees, which is end of year one divided by 110%, plus another 100 rupees, which is end of year two divided by 1.21, which is 110% into 110%.
Okay.
Okay.
Understood, sir.
Understood? Okay, perfect. What else? Okay. If there are no further questions, we can stop.
So,
Uh,
okay,
yeah, please tell me.
our presentation, is it supposed to be concentric around our business prospect, as in the ideas that we're planning on introducing, or merely the financials of the business? Like, let's say we talk about the DTC. Do we speak about what we're planning on doing differently in this business to conquer
Yes,
heavily
you should have a description sheet as well.
a description sheet as well,
Yeah, yeah.
which involves, so how would that description sheet be? Like an extremely elaborate business plan or just the pointers of,
No, just pointers, just pointers. As I said, that should just lay out and explain what you're doing in the financial model.
okay, all right.
Okay. You don't need a separate PPT because, see, essentially your Excel itself should be presentable enough. That's what we're going to look at. Okay.
So we don't need a presentation, we need an Excel sheet which is going to explain
Yes,
the
yes,
money
yes.
movement of the business.
Yes.
All right, thank you.
You can make a presentation, but not needed. Okay.
So what's the miscalcs about?
Ha.
Am I seeing it?
So now miscalcs, essentially, there are certain things here where you might want to uh, look at specific pieces of calculation which you don't want to put in your overall assumptions or things like that. So for example, depreciation calculation, because it's a little typical, because year on year, you'll have a certain amount of infra capex or capital expenditure that you're doing. And then you have to calculate the depreciation on it, which will come year on year. So that you can choose to keep separate. You can keep tax calculation also separate, right? And terminal value is nothing but your, you can, when you have a business which is going on for 10 years, at the end of 10 years, you also have to ascribe a certain value to it. So that you can calculate in a separate sheet and then bring it back.
Okay, sir. So we have to make that separate sheet here. You don't have to show that separate sheet.
Not needed. It's just there in case you want to keep some miscellaneous calculations. But again, the miscellaneous calculations should also feed into your statements.
Okay, sir. So ideally, what we have to do is that the terminal value calculations have to be done on a sheet somewhere else, and then just input the values. Or
Input
can
the
we
value.
just put the formula here?
Link it. No hard coded.
How would we link a formula?
So no, link in the sense. So let's say you are calculating a terminal value here through something. Okay. Now, in your statements, what you would do is your final cash flow. If you're projecting till say, let's say year 10, right? Just column L. So then what you would do is beyond column L, column M is where you would link it with your terminal value. That's it.
Okay, okay, okay.
Okay.
Yeah, got it.
Okay. Several more hands up. Kushan again, Temi.
Can our brand slash company be based in any country that we feel is optimal, or does it have to be based in India and obeying Indian law?
It could be based in any country, but it predicates that you know about that country and the assumptions you're taking are reasonably okay or
Okay,
correct about that country. Okay.
thank you.
Okay. Swara.
Yeah, so the slide deck is supposed to be like a pitch deck, right? Or is it
So
supposed
there's
to?
no slide deck needed. There's just the Excel, just the spreadsheet that you need to present. That's all.
And then we also have to make an assumption
You
sheet.
should make a description sheet which covers your overall assumptions and how you're approaching the full problem. Okay. Arnav.
I had a concern regarding the date. So is it going to be both on the 6th and the 7th of December?
So
Like
we'll
the
see. We'll try to do everything on the 6th, but in case it spills over, a couple of teams might go to the 7th.
because actually I'm appearing for the SAT and that's on the 6th of December. So
Okay. Just drop me a line separately and we'll take it up, Arnav.
okay.
You're in which grade, Arnav?
11th.
11th. Okay. Got it. Anirudh.
Hi, sir. Sorry. Like somebody already mentioned about slides and you said that it wasn't necessary. So I just wanted to clarify the sheet is what's necessary and slide is not what we need to do, right? We just need to walk you through the
Just take us through the description. If you want, actually, maybe what you all can do is, since a lot of you have asked this question, put a sheet here which captures your key outputs.
so like total net worth, total
Total
cash
net worth, what you're feeling, what the key variables are, how the model accounts for it,
and
what
then
your rough
maybe
valuation is, and things like that.
and
Okay.
then description and the key outputs.
Yes. We'll go
Okay.
through the details as well as we did for round one. But yeah.
All right.
Okay. So no need to make a separate presentation. It'll just make life complicated for you guys. Just focus on the spreadsheet. Just focus on making that very professional. Okay. Udyat.
So, sir, I wanted to ask what time will we have to present on the 6th and 7th because we have a pre-board on the 6th.
We'll figure out, Udyat. We'll figure out closer to the date, but we'll take
Okay,
that into account. Just drop me or Abhishek a line and we'll figure out the time accordingly.
okay, sir.
Okay. You're in 10th, huh, Udyat?
Yes, sir.
Okay, understood. Nakash, tell me please.
So while calculating the valuation, we can do that just by taking the standard multipliers on our top line and our cash flows, right?
Yeah. Standard multipliers meaning?
Like generally for different industries, they put different multipliers on your revenue to value your business.
Yeah. So good question actually. How you should do it is the best way to do it is to put two or three different ways of valuing the business.
No.
Okay. And
Okay.
then you can triangulate it to give a range.
All right. Makes sense. Also,
Okay.
so uh, how many cities are currently participating in the city rounds?
Four, five, four cities primarily
All right.
who've qualified for the next round. So right now, you guys, there are teams from Bangalore, uh, Delhi, Bombay, Hyderabad. Delhi, when I say, I mean NCR.
And how many positions are there for the finals at IIMB?
So top two teams from each region.
All right.
Yeah, Naitik, tell me please.
So do we have to be restricted to just two sheets? Like not sheets,
No,
but
no, no, no. You can build as many as you want. This is just a template.
No, I mean statements like a profit and loss and cash flow statement. Can I add potentially a balance sheet statement as well?
Yes, you can. Please do. It completes the business. It's not essential, but if you're able to do that, awesome. Just as an aside, though, a balance sheet is requires a fair bit of thinking to make, and it should balance in the sense that it should not have any plug items which balance the sheet. It should balance basis the different line items which come together. So therefore, take a call. If you want to put a balance sheet, please, more than welcome.
Okay.
We'll
Thank
be
you.
super impressed.